You trust your bank, right? You give them your paycheck, your savings, your future. They give you a nice app, polite emails, and a smiling face behind the counter. Seems fair, but what if I told you your bank might be robbing you quietly, efficiently, and with a smile? This is the story of Wells Fargo, the bank that didn't just steal from its customers, it invented them. We called it cross-selling. You know, offering customers multiple products, a savings account, a credit card, a car loan. Sounds harmless, but we took it to a whole new level. Our motto was simple: 8 is great. 8 accounts per customer. Didn't matter if you needed them. Didn't matter if you asked for them. We'd open them anyway. Because growth looks good on paper, and paper is what Wall Street worships. Inside the bank, we had a culture of pressure, perfection, and panic. Every employee had impossible sales goals. Miss your target, you're out. Hit your target, and congratulations, tomorrow your target goes up. It was a treadmill of greed, dressed in khakis and corporate slogans. At first, the creative solutions were small. A few fake accounts here and there to meet quotas. Maybe a new debit card for a customer who didn't really want one. But greed, my friend, is like compound interest. It grows fast. Soon, our employees were opening millions of fake accounts, moving money between them to make them look active, charging fees, signing people up for credit cards they never requested. When people started getting mysterious letters, "Congratulations on your new credit card," they thought it was a mistake. They called us. We told them, "No, sir. You authorized this. Maybe your spouse opened it?" We made them doubt themselves. We gaslit millions. It wasn't fraud. It was customer service with a twist. By the time regulators noticed, over 3.5 million fake accounts had been created. That's not a glitch. That's a business model. But here's where it gets really beautiful. While our employees were drowning under sales quotas, our executives were swimming in praise. Wells Fargo was the golden child of Wall Street, the ethical bank. We survived the 2008 crash looking cleaner than the rest. While other banks were accused of blowing up the economy, we stood there shining, pretending to be the good guys. Our CEO at the time, John Stumpf, loved that image. He'd go on TV and talk about values, trust, and the customer relationship. He even said we had the best people in banking. He wasn't wrong. We were the best at pretending. Inside, it was a cult. Every day, employees got pep talks about selling more. Branch managers handed out daily scorecards. People were crying in bathrooms, terrified of losing their jobs. Some quit, some faked sales, and the few who dared to speak up, fired. They called it non-performance, because technically, if you weren't faking accounts, you weren't performing. When the story finally broke, we did what every respectable company does when it gets caught: we lied. We blamed a few bad apples, as if 3.5 million fake accounts were just an accident. A few bad apples? We had an orchard. John Stumpf went before Congress, smiled like a saint, and said the problem was limited to a small number of employees. Lawmakers scolded him on TV. He nodded, apologized, and left with a $130 million retirement package. Meanwhile, regular employees were getting fired for doing exactly what corporate training told them to do. They didn't invent the scam, they just scaled it. And that's what Wall Street really rewards. The regulators came for us eventually. The Consumer Financial Protection Bureau fined Wells Fargo $185 million, a record-breaking penalty. Sounds dramatic, doesn't it? Until you realize the bank made $22 billion that same year. The fine was less than 1% of profits, like dropping a $10 bill and calling it a tragedy. We issued public apologies, promised to change, and ran heartwarming commercials about rebuilding trust. But the truth? We didn't change much. The system didn't want us to. The system rewarded us. Our stock dipped for a bit, then bounced back. Investors realized something important. If you can scam your customers that efficiently, you're still a good investment. And let's be honest, the customers forgave us. They always do. Because what are you going to do? Stuff your money under a mattress? You need a bank. You need us. So we smiled, replaced a few executives, and moved on. The headlines faded. The ads kept running. The profits kept rolling in. People like to believe that Wells Fargo was an exception, that this was one bad company, one bad chapter. But let me let you in on a secret: we're all Wells Fargo. Every major financial institution dances on that same line between profit and fraud. The only difference is who gets caught. We just took the concept of trust, the foundation of banking, and monetized it. We discovered that people don't read the fine print. They don't question authority. They don't cancel their accounts after a scandal. They just get mad, post a tweet, and keep banking. And that's why corporate crime always pays. It's not that regulators are blind, it's that they're outnumbered. The financial system is built to be too big to fail, too confusing to fix, and too profitable to stop. We break rules faster than governments can write them. So, while politicians gave speeches and customers shouted on hold, we adjusted our spreadsheets and moved on to the next quarter. And John Stumpf? He left with his millions. The next CEO came in, said all the right things, fired a few more people, and rebranded the same culture under new slogans. Wells Fargo 2. Cleaner, safer, more transparent. The commercials looked nice. You might have even believed them. But the truth is, there's no such thing as a clean bank. The dirt's just better hidden. The real story of Wells Fargo isn't about fake accounts. It's about a system that rewards deception as long as it's profitable. The sales targets, the pressure, the denial, all of it was designed to make people do the wrong thing the right way. And they did, brilliantly. That's what made the scandal so perfect. It wasn't a few bad employees. It was a perfectly engineered fraud, run by thousands of ordinary people following orders, trapped in a culture that punished honesty and glorified numbers. So what's the moral of the story? Simple. Don't trust your bank, but you will anyway, because you have to. And we know that. You think you're the customer, but you're not. You're the product. Your loyalty, your data, your financial history, all assets to be bought, sold, and leveraged. Wells Fargo didn't invent corruption. They just perfected the workflow. They took fraud and turned it into a feature. And when the truth came out, they didn't lose everything. They lost a little reputation temporarily. But reputation, like money, can be rebuilt with marketing. They ran new ads. They changed their logo. They smiled. They said, sorry, and people believed them. Because in the end, people don't want justice, they want convenience. And Wells Fargo still had the best app. So next time you see a Wells Fargo commercial about earning your trust again, just remember, they never lost it. Not really. Because the moment your paycheck hits their account, the cycle begins again. You work, you save, you trust, we take. It's nothing personal. It's just business. And business is good. We didn't just fake accounts. We faked accountability.